If you could grow your wealth by simply owning a handful of companies that represent the entire global economy, would you do it? That's the power of index funds. They're the easiest, smartest, and most proven way to build long-term wealth, without the stress of stock picking or market timing. In this video, we're breaking down the top 5 index funds for long-term growth, funds that can help you retire comfortably, live freely, and let compounding do the heavy lifting. Schwab US Broad Market ETF, SCHB. At number 5, we start with a quiet giant, the Schwab US Broad Market ETF, ticker symbol SCHB. This fund is one of the most cost-effective ways to invest across the entire US stock market. Details. Tracks: Dow Jones US Broad Stock Market Index. Holdings: over 2,500 companies. Expense ratio: 0.03%. 10-year average return: around 10% annually. That 0.03% fee means you'd pay only $3 a year for every $10,000 invested, practically nothing. What makes SCHB powerful? It blends stability and growth by covering large cap, mid cap, and small cap stocks all in one place. You get exposure to market leaders like Apple, Microsoft, and Amazon, but also to the smaller innovators that could become tomorrow's giants. Why it's great for long-term growth? Just because of ultra-low fees. Broad diversification. Great for hands-off investors. Perfect for taxable accounts, highly tax efficient. If you want a one-stop US market investment that quietly compounds over time, SCHB is a great starting point. Vanguard Total Stock Market Index Fund, VTI, VTSAX. At number 4, we have an investor favorite, the Vanguard Total Stock Market Index Fund, ticker VTI, ETF, or VTSAX, mutual fund. This fund is often called the core of a millionaire's portfolio, and for good reason. Details. Tracks: CRSP US Total Market Index. Holdings: over 4,000 US companies. Expense ratio: 0.03%, ETF, or 0.04% mutual fund. 10-year average return: around 10.2% annually. Why it stands out? VTI owns every publicly traded US company, from trillion-dollar tech titans to small, fast-growing startups. That means you don't have to guess which company will outperform, you own them all. Example: when Apple or Nvidia rises, you benefit. When small caps rally, you benefit again. It's pure market exposure. Why investors love it? Covers the entire US economy, consistent long-term growth. Suitable for any experience level. Extremely liquid and easy to buy, sell. If you believe in America's long-term innovation, VTI is a simple and smart, buy and hold forever, choice. Vanguard S&P 500 Index Fund, VOO, VFIAX. Number 3 is the legendary Vanguard S&P 500 Index Fund, available as VOO, ETF, or VFIAX, mutual fund. This is the classic choice for investors who want to track the 500 most powerful US companies. Details. Tracks: S&P 500 Index. Holdings: 500 largest US corporations. Expense ratio: 0.03%. 10-year average return: around 11% annually. The S&P 500 has returned roughly 10 to 11% per year for nearly a century, a performance few can match. When you buy VOO, you're essentially buying ownership in the companies driving the US economy, like Apple, Microsoft, Tesla, Google, and Amazon. Why it's a wealth-building machine? It's simple, low cost, and backed by decades of reliable performance. Over time, Compounding turns steady returns into exponential growth. Example: $10,000 invested in an S&P 500 index fund 30 years ago would be worth over $200,000 today. Even Warren Buffett has said, "When I die, put 90% of my money in an S&P 500 index fund." If you want to mirror the market's success with minimal effort, VU is your go-to. Vanguard Total International Stock Index Fund, VXUS. At number 2, let's move beyond the US, with the Vanguard Total International Stock Index Fund, ticker VXUS. Most investors forget, the world doesn't end at the US border. Global growth is happening in Europe, Asia, and emerging markets, and VXUS lets you benefit from it. Details. Tracks: FTSE Global All Cap ex-US Index. Holdings: over 8,000 companies. Expense ratio: 0.07%. 10-year average return: around 7 to 8%. Why it's valuable? VXUS gives exposure to developed markets like Japan and Germany, as well as emerging markets like India, Brazil, and China. These economies can deliver strong long-term growth potential and help balance your portfolio. Example: when US markets dip, international markets sometimes outperform, giving your portfolio stability. Why it's great for long-term growth. Geographic diversification. Exposure to developing economies. Reduces dependence on one country's market. Pairing VXUS with a US index fund like VTI gives you total global coverage, a world-class investing strategy for decades to come. Vanguard Total World Stock ETF, VT. And finally, at number 1, the Vanguard Total World Stock ETF, ticker VT. This is the ultimate index fund for long-term investors who want everything in one place. Details. Tracks: FTSE Global All Cap Index. Holdings: over 9,000 companies across 40-plus countries. Expense ratio: 0.07%. 10-year average return: around 8.5%. Why it's the best number one choice? VT combines US and international exposure into a single fund, giving you access to the entire world's stock market. From US tech to European pharmaceuticals, from Japanese manufacturing to Indian startups, VT owns them all. Why investors love it? Instant global diversification. Low fees. Balance between growth and stability. Simple. One fund. Solution for lifelong investing. If you want to invest once, automate monthly contributions, and forget about rebalancing, VT is the ultimate hands-off growth fund. Example: $500 invested every month in VT for 30 years at 8.5% annual returns grows to nearly $745,000. That's the quiet power of long-term, global investing. When it comes to investing, it's easy to get lost in the noise, meme stocks, crypto hype, short-term trades. But if you've made it this far, you already understand the truth. Long-term wealth isn't built overnight. It's built consistently, year after year, through patience and smart strategy. The 5 index funds we covered today, whether it's the S&P 500 giants like VFIAX or FXAIX, in QQQ, all share one thing in common: they're designed to grow steadily with the market, not fight against it. Over decades, these funds have proven that you don't need to pick the next big winner to become wealthy. You just need to stay invested, reinvest your dividends, and let compound interest do its magic. Let's put this into perspective. If you invest even $500 per month into a broad market index fund and earn an average of 8% annually, in 30 years, you'll have over $700,000, double that to $1,000 per month. And you're looking at nearly $1.5 million, and that's without chasing risky trades or timing the market. That's the true power of index investing. Time and discipline beat timing and luck. So as you look to the future, ask yourself, do you want to spend years guessing what the next big stock will be, or do you want to quietly and confidently own the entire market, sit back, and let your money work for you? Because the reality is, the most successful investors, from Warren Buffett to everyday millionaires, understand that the road to financial freedom isn't complicated. It's simply built on consistency, low fees, diversification, and time in the market. So start today, even if it's small. Even if it's just one fund, start building your portfolio for the future you deserve. And remember, the best time to plant a tree was 20 years ago, the second best time is today. Thanks for watching. If you found this video valuable, hit that like button, comment down below your thoughts, share and subscribe for more deep dive investing videos.